Okay, in these study objectives, we're going to learn about the entire recording process. So to start with, um, uh, we're going to analyze transactions in terms of the effect on the accounts that are involved. Then we're going to enter the transactions in what's called a journal. So we'll have the journal as a listing of transactions that are engaged in by a company, and then we're going to have to transfer that journal information to the appropriate accounts in the ledger. A ledger is a place where you keep track of all the balances in each individual account. So if you have 7 transactions involving cash, the ledger will have the overall cash account, and it will show all 7 transactions coming together in one, what we saw to be a T account type situation. Um, the journal, conversely, is just a listing of transactions, so it doesn't provide any balance information for any individual account. It's just a chronology of transactions. So keep those straight in your head. So a journal, basically what I just said, you would have situations like this. Here's some of those transactions that we saw earlier in the chapter, when issuing common stock in exchange for cash, borrowing $5,000 by signing a note, buying equipment for $5,000. We saw what the effect on the accounting equation was in those situations. This is what you'd see in the journal, because we're not recording increases and decreases like this. We're doing journal entries. So for the issuance of common stock, you would list the debits first. So cash gets debited first for $10,000. Common stock is credited for $10,000, because debits to an asset make it go up. Credits to equity accounts make it go up. So this is a very common way. This is not very common. This is the way that transactions look if you were going to be writing them down in some kind of on paper. Which in an online class you won't be doing that like you would if this was a face-to-face class. But this is how it's done and how you'll see it in the rest of the textbook. So, you can see from the other transactions how you would record them as well. When you borrow money, your cash is going up, so you debit cash, 5,000. Notes payable, this is a liability. So when you borrow money, you have to pay it back, and that represents a liability. And so notes payable would be the specific account that we use to record that liability. And the liabilities we saw are credit balances, so we have to increase the note payable by crediting it. Buying equipment, equipment is going up because we're buying it, so we have to debit it because it's an asset. Assets go up with debits. Cash is going down because we're spending cash to buy the equipment, so we credit cash, which is the asset. Assets go down with credits. So you have to get really good at this idea of knowing what has to be debited and credited depending on whether or not the account is going up or down. So that's recording in the journal. And then study objective 6 shows you what a ledger is. So you can see within the asset classification, there's a bunch of different asset accounts, and there's even more. I mean, as many as the company needs. They would have an account for every kind of thing that's relevant for their business. Liability accounts, lots of different liability accounts. Stockholders' equity, lots of different accounts there too. Common stock and retained earnings are the primary two, but then dividends, and then tons of individual revenue and expense accounts would probably exist. So all of those journalized transactions that you saw up there would be posted then into their appropriate ledger accounts, so we can come up with balances in each one of these accounts. You can't do an income statement or a balance sheet until you've got balances in all of these accounts for a period of time or as of a point in time. So this posting process into the ledger is very important. Here's an example of a chart of accounts like I mentioned earlier. And then study objective 7 talks about posting. So again, these tutorials might be very helpful to you if you're having any trouble going forward with what I've kind of laid out to you here. And then also in the next slide you can see, well actually, you know what, I'm going to stop this one here and I have one more video in this chapter.